Hi everyone, welcome back to Myth vs Market, the show where we test the most popular trading ideas on real data and reveal whether they are market truth or just another trading myth. In the last episode, we dissected Day Trader Telugu's short strangle, a strategy that revealed multiple parameters and plenty of useful insights to help us make better trading decisions. Now, it's time to move one step further and explore something new, a strategy that can take those learnings even deeper and help us trade with even more confidence. In today's episode, we are diving into something equally famous, the Theta Gainers Straddle strategy. Now, this isn't your typical short straddle where you just sell both ATM options on a Thursday and hope the market stays quiet. Here, Theta Gainers add some smart adjustment logic and timing tweaks that can make a huge difference in how the strategy behaves in live markets. So first, let's quickly understand what this setup is all about. We'll go over the basic rules, the variations we tested, and then the big question. Is this another overhyped idea, or does the Theta Gainer straddle actually have the edge to perform consistently in real market conditions? Alright, let's first look at the weekly version of the Theta Gainer straddle strategy. We enter into the trade on every Thursday or currently Tuesday between 3 and 3:25 pm using ATM call and put strikes. It's simple. We sell both sides and let theta work for us overnight. But here's the key: risk management. If the total loss on the straddle crosses 80 rupees per lot, or if the delta difference between the two legs goes beyond plus or minus zero point 0.4, we immediately close the existing straddle and create a brand new ATM straddle again. Optionally, we can add a small hedge around 3:25 pm to protect us against overnight gap ups or gap downs, and exit the hedge at 9:20 am the next morning. And finally, our exit rule: book profits once we reach about 1 to 2% gain on the total deployed capital. So, this weekly straddle is very simple, disciplined, and perfectly designed for short term theta collection with controlled overnight risk. Now, let's move on to the monthly version. Same logic, but with a bigger time frame and wider profit targets. So we initiate the trade on the very first trading day of the month, again using the same ATM call and put strikes. So coming to the adjustments, whenever the loss crosses 80 rupees per lot or the delta difference exceeds plus or minus zero point 0.4, we square off the existing straddle and build a fresh ATM straddle again. Hedges also work exactly the same way. Add around 3:25 pm and remove at 9:20 am the next morning. They are optional but extremely useful during event heavy months. Here, our profit target is slightly higher. We exit once the position reaches around 4% of the total capital. So, the monthly version focuses on slower and steadier theta decay with similar adjustments but longer holding time. Now, a few advanced pointers that make this strategy stand out. Whenever we are performing on monthly adjustments, we can add a small weekly sell to help balance out the delta and reduce the directional exposure. Typically, we place that weekly sell about 10 strikes away from the current ATM. For example, if the market is trending upward and pressuring the call side, we'll add a put sell 10 strikes away to balance out the position. Also note that all strike selections are based on the futures price, not the spot. This keeps the alignment consistent with the actual tradable underlying. These tweaks may sound minor, but they make a huge difference when the market starts trending, keeping the overall position more balanced, less volatile, and letting the theta keep doing its work quietly in the background. So let's now deep dive into the backtesting results. On the screen here, you are seeing the performance of weekly straddle with 30% individual leg stop losses, and the results look very impressive. This setup delivered a total PNL of more than 3 lakhs from 161 trades with a win rate of 69%. The average profit per trade is around 1900, while the max profit reached 16,000. The max loss was limited to 14,000. Even the max drawdown stayed near 18,600, showing how well the stop loss rule protected the capital. Overall, that's a return of roughly 33%, even with today's higher margin requirements. Back in 2022 and 2023, when the margin requirements were lower, this same logic could have easily delivered close to 100% returns. So yes, This is a genuinely stable risk management strategy, not just another backtest curve. Here, we simply enter on a Thursday, hold till next Thursday or currently Tuesdays, and let the 30% leg stop loss handle the volatility. Most of the losing weeks came from those typical zigzag market moves. But the broader picture is very clear. Steady, consistent income weeks far outweigh the small losses, making this one of the most balanced versions of the straddle. And since many of you have already watched our previous episode of Day Trader Telugu Strangle, you're familiar with how to interpret each of these parameters like total PNL, win rate, max drawdown, or others. So we won't repeat it again here. So if you have missed that episode 1, you can check it out later. The section explains all the metrics in detail. For now, let's focus on how this strategy behaved and what really drove those numbers. When you look at the overall profit and loss trend, it's hard not to smile. A smooth, steady climb with only few mild pullbacks. That's exactly what we want to see in a stable, rule-based strategy. The equity curve shows consistent growth and yearly breakdown confirms it. Almost every year ended in profit, which is a very healthy sign. This setup is as straightforward as it gets. Sell ATM straddle, apply a 30% stop loss on each leg and let the time decay do the work. No complex logic, no fancy adjustments, just pure discipline. That said, most of the big returns came in the recent year, while the earlier years were more balanced. Not exceptional, but not disappointing either. Still, the stability and simplicity make it one of the most reliable short straddle frameworks we have tested so far. Moving to the next setup, the weekly straddle with adjustments. This one follows the same entry logic as before, but a key difference is how we handle the market imbalance. Whenever the delta difference between the two legs crosses plus or minus 0.4, we square off the existing straddle and recreate a new ATM straddle at the latest market level. It's an active approach, not waiting for the stop losses to hit, but stepping in early when the position goes off balance. Now, in terms of performance, this version delivered a total PNL of more than 2 lakhs from 165 trades with a win rate of 63.6%. The average profit per trade comes around 1200 with a maximum profit of 20,700 and a max loss of 26,500. The maximum drawdown also was around 26,500, showing that even though the profits are slightly lower, the risk control has improved significantly. So yes, compared to a 30% stop loss version, this gives smaller overall returns, roughly 20% annually, but it compensates with a better stability and more predictable drawdowns. When you look at the payoff curve and yearly performance, you will notice fewer deeper dips and smoother equity line. That's the trade-off here. By adjusting actively, we give up a bit of profit potential but gain much more consistency. And that's exactly the kind of market behavior we want from a strategy designed to survive all kind of market conditions. Not flashy returns, but controlled and repeatable outcomes. To really understand how this management works in real time, let's look at an example from the June 30th, 2022 trade. We started the straddle at around 15,800 with a call value at 150 rupees and the put value at 207 rupees. Almost immediately, the very next day, the premium went off balance. The put shot up to 305 while the call dropped to 83. So, as per Delta rule, we closed the existing position and created a fresh straddle at 15,600, selling the CE at 164 and PE at 185. But the market wasn't done yet. This combination hit our imbalance trigger again on July 1st at around 3:13 pm. So we exited and entered again, this time at around 15,750 with a premiums of 154 and 152. Then came July 5th. The market opened with a small gap up and forcing the adjustment right at 9:16 am. We had to rebalance again during the day at 11:27 am and 1:58 pm as the market kept swinging rapidly. Even on July 6th, another adjustment was needed at around 12:51 pm and finally one more just after the open on July 7th before we closed the trade at around 10:30 am. If you look at the graphs, you will see the exact zigzag movement, short choppy swings that forced multiple re-entries. Each adjustment helped us to stay balanced and avoid any large directional loss. But since the market never settled, we finally closed the week with a small overall loss. And that's the key takeaway. These quick adjustments don't always guarantee profit, but they protect the capital during the unstable weeks, making sure one bad move doesn't turn into a big drawdown. The next strategy we tested is a monthly straddle with adjustment. On paper, it looks almost identical to the weekly version. The only change is that we make the trades using the monthly expiry options and hold them longer, making the adjustments whenever the delta imbalance crosses plus or minus 0.4. In this backtest, the total PNL came around 88,000 from 38 trades, and the win rate is around 60%. The average profit for this particular trade is around 2,300, while the maximum profit touched around 40,000. The maximum loss went up to 49,000. So the drawdown was quite high at around 53,000, showing that long holding periods expose the position to bigger swings. Now, if you look at the payoff graph, that is not very encouraging. These long sideways stretches followed by a deep drops, a clear sign how difficult it is to manage a naked straddle over an entire month. Because the market tends to swing multiple times within that period, the adjustment end up reacting to the noise rather than protecting the position. And that's the main issue here. While this version still made a small profit, the risk to reward ratio isn't healthy. The gap ups and gap downs have much larger impact when you hold for weeks without complete protection. It's a classic case of too much exposure for too little reward. The yearly performance report also reflects the same story. A few good months and a few bad ones, but overall result doesn't justify the effort or the capital locked in. So even though the logic and adjustment method are the same for the weekly version as well, the monthly cycle simply carries too much risk for the kind of return it offers. In short, while it works on paper, in real market, this version would need much stronger hedging to make it more practical. So these are the profits and win rates across multiple parameters. Like the first one is having a weekly straddle and adjustments is pulling up the profit side near to the lossy side or pushing the lossy side further away to generate more profit. As you see, this is also not having a great return, not up to a level of risk versus reward. Now when we talk about the monthly straddle with adjustments, this is the same simple adjustment method that is explained in the original Theta Gainers video. We also tested few additional versions to understand how protective layers affect the performance from the same video. One version included a day-end protection where we hedge the position at the close and remove those hedges in the next morning. While it added safety cushion, the overall returns dipped slightly. That's because realistically, we don't see gap ups or gap downs every single day. So on most days, those extra hedges just ate into the profits, giving protection, yes, but at a cost. We also tested a monthly straddle with weekly adjustments in between, just to see if combining both timeframes could offer smoother performance. Even that didn't show any significant improvement. The strategy logic in the original design mostly focused on one directional market move, not on what happens during a zigzag or sideways phases. And that's where it struggled. So after running all these variations, the conclusion was quite clear. Out of everything we tested, only two versions truly stood out. The weekly straddle with 30% leg stop losses and the weekly straddle with adjustments. Both managed risk very well, delivered consistent results and stayed relatively stable across market conditions. The rest, they work sometimes, but not consistently enough to rely on in real world trading. Now just imagine how much effort it would take to test 3 full years of data across 14 different parameters like this. Luckily, we have automated it. So we can run this backtest quickly and accurately. We would love to take this strategy further and test with even more variations. So do let us know in the comment section below what kind of parameters or adjustments you would like us to try out next. The strategy we discussed today is originally from Theta Gainers. If you would like a deeper explanation of their approach and logic, you can find the links to their original videos in the description below. Do check these videos as well. They'll give you more insight into how this strategy was built and tested. So, a couple of observations from our side on the backtested results. If you are new to options or still learning market behavior, stick to weekly straddles. They're easier to monitor, require smaller conviction, and react faster to adjustments. Jumping straight into monthly straddles without experience is asking for trouble. Even in Theta Gainer's original explanation, he clearly says simple math won't save you. If you can't read the trends, understand the market tone, you shouldn't trade monthly straddles at all. Straddle adjustments sound mechanical, but they demand strong market conviction. You must know why you are adjusting, not just when. Without that clarity, even a perfect system can turn into a losing one. The core idea behind this strategy is genuinely smart and well thought out. It can work beautifully, but only in the hands of traders who combine it with a technical analysis and disciplined execution. So, yes, the logic is solid, but it's not just a plug and play. When compared with the day trader Telugu strangle strategy we tested earlier, the Theta Gainer straddle clearly shows a better overall performance and a stronger edge in adapting to the market behavior. Both strategies highlight different approaches. One focuses on simplicity and execution, while the other brings deeper market interpretation and dynamic adjustments. Together, they reflect how retail strategies are gradually evolving into more data driven, structured system, each addressing risk and reward in its own unique way. So, there you have it, the Theta Gainer straddle strategy, backtested and decoded. What looked like a simple premium selling setup actually hides a lot of moving parts. But with the right rules and timely adjustments, it can turn into a steady income strategy instead of a risky bet. In the previous episode, we covered Day Trader Telugu's strangle strategy with adjustments. If you haven't watched it yet, it's linked below. Make sure to check it out after this. If you have enjoyed this episode of Myth vs. Market, please drop a like and comment which strategy you would like us to test next. Iron Condor, Butterfly, maybe something completely new. See you in the next episode. Until then, trade safe, stay curious, and keep testing your myths with Myth vs. Market.